Good morning, Shobana. Can you tell us, and first of all, congratulations on the deal that has happened. Will the proceeds from the stake sale be utilized to pay off the debt, and how will the funds be deployed? Because you're getting close to 300 crores for the listed entities.
On all counts, this was not this was not a forced sale. This is a strategic exit. And having said that, we have the ability to deploy wherever there's more shareholder value. So I think that there's enough in India to be able to create more greenfield, to invest, and also to reduce debt. So it will be judicious.
Shobana, the other part was there is a lot of concern over the promoter pledge over the last few quarters. Are the promoters now looking to reduce the pledge via this fund infusion? And if you can give us an indication of the ballpark figure of how much funds will be used to bring down the debt, bring down the promoter pledge in the company?
I think that I can't really, because this still has to go through all IRDA and many other things. So when that comes at that point, it'll be deployed very judiciously to do this also, because we do believe in the safety and so the promoters had a pledge. It was a bit too high, and I think that will be reduced.
When was this process started to exit this business? Were there any other contenders, or was it just the HDFC Group?
It was more in terms of because we have the same partner. You must understand that Munich is sitting on both sides. The entire process was done so that we could work with so that we could work with the same partner. And HDFC was a natural. So we explored that avenue first. They came up to the valuation expectation, and I think that's why the deal got done in a record time.
Were there any other contenders? You didn't answer that. Was HDFC the only one, or were there other contenders also?
There were many other interested. It's not like there were no contenders. Everyone was interested because it's a great asset. But it was just that we didn't run a formal process.
Are you happy with the valuations that you've gotten for this deal?
It's definitely, for a 300 crore investment over 10 years, we made a 400%. We made 4 times. So I think it is a good.
Okay, Shobana, before we let you go, my final question is there any non-compete clause that was signed because of this deal?
Yes, there is. No, yeah. Won't invest into insurance for the next 3 years.
Okay, Shobana, thank you so much for speaking to Bloomberg Quint. So, Neeraj, that was the company that was acquired, and we believe we have the acquirer also with us.
Yeah, now we have the acquirer joining us on the phone line as well. Ritesh Kumar, Managing Director and CEO at HDFC Ergo General Insurance, joins us right now on the show. Ritesh, good having you, and congratulations on the deal. Just a formal clarification. Our calculations show that the combined entity, HDFC Ergo and Apollo Munich, would have a combined market share of about 6.4%. Would that be ballpark the correct estimate, or would it be slightly different?
Yeah, good morning. Yes, the combined market share of the two entities would be 6.4% as of FY19. We have a market share of 5.1%. Apollo Munich has a market share of 1.3%. So put together, the market share adds up to 6.4%.
Most analysts that we spoke to, Ritesh, mentioned that you got this deal at a fairly decent valuation as well. Is that was that a comfortable number for you to give? And I would presume that you would be hungry for more as well. Is that the ballpark range at which you believe insurance players would currently be valued? And if you can talk about the synergies now that the market share goes up about this much, because Star wasn't performing as well as maybe it would now, or rather Apollo Munich wasn't performing as well as it would now. It's under the umbrella of HDFC, as it would under the umbrella of HDFC, I presume.
So let me just briefly talk in terms of the core rationale behind the entire sort of deal.
Sure.
The fact remains that health insurance as a segment is the fastest growing segment within the general insurance space. And I mean, if we look at the numbers over since the time the market the insurance space opened up, While general insurance has been growing at a 17% CAGR, health within that has grown at a 24% CAGR. Our expectations also are that over the next 5 years, health and accident combined will emerge as the largest segment within the general insurance space. So that is really sort of what the core rationale is. For any deal to happen, obviously, there needs to be a price expectation which needs to be matched between the buyer and the seller, and that is how sort of this has happened.
Okay.
The other question that you asked about on the synergies, we expect significant synergies to come in sort of by way of this deal. The combined market share on accident and health sort of put together adds up to 8.2%. Apollo Munich has a wonderful book. However, given the fact that they were only a 2,200 crore company and significantly investing sort of for the future, that is why their profitability was slightly lower than what it would logically have been. With this, once the merger is effected, both the entities would benefit from further economies of scale. And that is how the future profitability would improve.
Just one cursory question. Would you be able to give us some sense of what the combined entities' key ratios could be like, claims ratio, ROE, etc.?
So general insurance is measured by the combined ratio.
Yes.
And that is the key metrics on which we sort of measure the performance. HDFC Ergo's combined ratio is 98.9% as of March 2019. Apollo Munich's combined ratio is 100.7. So if we put these two numbers together, the combined ratio would be sub 100%. And that's something, any number below 100% is a fairly good number.